Joe Biden, in his battle against the price at the pump, has decided to release US reserves. But was this a good decision? And are OPEC going to retaliate? Economic data out this week shows the situation in the US with inflation isn't getting any better. But what did the Federal Reserve's meeting minutes, released just yesterday, reveal about their next likely actions? And why is the cost for Eurozone banks to borrow overnight more expensive than it is to borrow for 3 months? All of that in today's Market Movers Daily. Happy Thanksgiving for those of you that celebrate it, and even if you don't, thank you, all of you, for supporting and watching this channel. We're really enjoying being active here again. So for the last 2 days, we put out explainer videos, one about the yield curve and one from our series where we're covering all the important economic data and explaining how they relate to each other. But a lot has happened in the past 2 days, so since we haven't had an episode of Market Movers Daily, we've got a lot to cover in today's one. As always, leave your opinions on any of today's topics in the comment section down below. It's really up to you guys to make that an interesting area to discuss these sort of things. And please do also hit the thumbs up button to support the channel. So we'll kick things off with Biden's battle against oil. You may remember in our previous videos on the topic, I said I didn't expect him to take any sort of meaningful action. So when the news was reported earlier this week that Biden would be releasing some of the SPR, the Strategic Petroleum Reserves, my reaction to my team was, well, he showed me. However, I then looked at the details and it seems that it's still more of a political gesture than anything meaningful. He's releasing 50 million barrels, which obviously is a lot of oil. But to put it in perspective, it's still only about half a day's worth of global consumption. In his statement, Biden said, "Before long, you should see the price of gas drop where you fill up your tank." But whether or not prices do actually fall, it's very unlikely to be because of anything to do with this SPR release. Firstly, it's not an instant solution. It will take months before that oil is actually available. Then there's the issue of US oil refineries being pretty much at capacity and struggling to increase capacity. So, releasing oil isn't very helpful to the situation if it's just going to be sitting there still in barrels. And that's before we even get onto the topic of what type of oil it is and whether it's really going to be solving the situation anyway and blah, blah, blah. Needless to say, this isn't the grand solution it's being played up to be by Biden. And that can be seen very clearly in the reaction we saw in the markets. Once Biden announced the SPR release, the price of oil, it didn't move down, it moved up. Now, interestingly, you'll remember from one of our last videos on this topic, I mentioned that prices could start creeping back up once we reach that previous high, and that's exactly what happened. So it seems the uncertainty about whether he would release reserves or not was holding back prices more than the action of doing it itself. Sell the rumor, buy the news, it seems. But I think the reality is that this is just a one-off token release of 50 million barrels, and it's done nothing for the situation. But relations between the US and Saudi Arabia aren't great at the moment, and Saudi Arabia are obviously one of the most influential members of OPEC. They're not going to be very pleased about this situation. OPEC meet and decide what they think is best on a monthly basis, and then Biden just comes in and decides he knows better and takes actions anyway. Now, there's a good chance that this is going to lead to counteraction from OPEC to offset what Biden has done. And in fact, in the Wall Street Journal, they've reported that Saudi Arabia and Russia are considering holding off on their next production increase of 400,000 barrels per day, although the UAE and Kuwait are apparently opposed to this. Now, the next OPEC meeting is just around the corner, and remember, these monthly meetings are currently to decide whether they stick to their existing plan or not. So that's going to be the thing to keep an eye on for the oil markets, rather than this token gesture from the US and the other countries involved, which Biden has clearly done as a political tactic, but that may backfire for him dramatically if OPEC throw their weight in the opposite direction. But let me know your thoughts on the situation. Do you think OPEC will hold back on their production increases? And do you back Biden with this action? Leave a comment down below and let me know. Now, obviously, rising oil prices aren't helping the situation with inflation, so let's switch our attention back to that. We had a lot of data released yesterday for the US. As we mentioned in a video earlier in the week, we had PCE data coming out, that's personal consumption expenditure, and this is very important because this is supposedly the Federal Reserve's preferred measure of inflation. And it came in pretty much in line with expectations, but that was still very high. So core PCE, which is excluding food and energy that are more volatile, that increased by 4.1% in October year on year. So that means compared to October of 2020. And if we add food and energy, we actually saw a 5% year on year rise, and that's up from the 4.4% we saw in September, which means that we're now looking at the highest levels since the 90s. Meanwhile, GDP, gross domestic product, and if you don't know about that, click up here to watch our explainer on that. GDP for the third quarter was a bit disappointing. It was expected to show a rise to 2.2%, but it only hit 2.1%, so it came in below expectations. Not a great sign with rising inflation and slower growth in the economy, but Q4 is expected to be stronger, so no real need to panic just yet. And other interesting data that was released was from the jobs market. Weekly jobless claims dropped to the lowest level since 1969. I wasn't even alive then. State unemployment offices took in 199,000 initial jobless claims on a seasonally adjusted basis, compared to 270,000 the week before. So the number of people actively collecting benefits has now dropped from 2.1 million to 2 million, showing that the labour market, which was already very tight, is only getting tighter. Now, earlier in the week, we spoke about the Federal Reserve and the fact that more of their members were coming out with comments suggesting that they were in favour of raising the pace of their tightening, speeding things up. And yesterday, we had confirmation of that being the case, with the meeting minutes being released from their meeting earlier in the month on the 2nd and 3rd of November. Now, keep in mind, that meeting was before all of this recent data has shown that inflation is rising even quicker. So in that meeting, they said, various participants noted that the committee should be prepared to adjust the pace of asset purchases and raise the target range for the federal funds rate sooner than participants currently anticipated if inflation continued to run higher. The meeting minutes did point out that they still expect the inflation rate to drop significantly in 2022, but some members thought that high inflation might be more persistent. So if we consider the fact that the data has come out since then showing things are worse, not better, I think we can expect that in their December meeting, they will be announcing that they're going to pick up the pace on their tightening. So basically the reason for doing that means that they'll have the option to raise rates sooner if they need to, since it's likely that they'll wait until tapering's finished before they start thinking about raising rates. If they can finish it sooner, if they need to, they can then raise rates. It was also announced just a few hours after I filmed our video discussing the topic, and in fact the announcement came out before the video, which was very annoying, that Biden had nominated Jerome Powell for a second term. Now, I'm not saying that President Biden has been listening to me, but if he has, happy Thanksgiving, Joe. Buck your ideas up, mate. Now, after being nominated, Powell said that the Fed will use our tools both to support the economy and a strong labour market, and to prevent higher inflation from becoming entrenched. Well, we shall see, Jerome. But let me know your opinion in the comments section. Do you think that the Fed will speed up their tapering in December? And do you think Biden picked the right guy, or would you have preferred Brainard? Not that she's a guy. Leave a comment down below, let me know. And finally, an interesting new twist in the financial markets, as if we need more of them, is that Eurozone banks are now having to pay more to borrow overnight than they do to borrow for 3 months. Since the ECB has pumped cash into the markets, banks are struggling to find a place to put it all. This means there's a shortage of short-term German bonds. So if you watched our explainer video about the yield curve, you'll remember that we discussed how longer-term funding should usually be more expensive than shorter-term. However, the ECB's bond buying program has led to there being 4.5 trillion euros of spare cash in the economy. So the short-term funding rate, which is the cost for 1 day, has pushed above the 3-month Euribor rate. Crazy times. Now, if you want to know more about yields and the importance of the yield curve, check out the video on screen here that we put out earlier in the week. It's an explainer about the yield curve. Hit the thumbs up button if you like this video, if you found it interesting, and I'll see you in the next one. Happy Thanksgiving. Thanks for watching.